Let me start with something uncomfortable. Most people watching XRP today are asking the wrong question. They're asking, why hasn't the price exploded yet? But that question only makes sense if you believe XRP was built to entertain traders. It wasn't. XRP was built the same way engineers build critical infrastructure, not to look impressive, but to work when everything else breaks. And today, I want to walk you through why XRP behaves the way it does, why institutions look at it completely differently than retail, and why silence, slow movement, and boring price action might actually be the strongest signal you're missing. This is not financial advice. This is education, so you can stop reacting emotionally and start thinking structurally. Retail investors are trained to look from the outside in. Charts, candles, momentum, targets. How high can it go? When do I sell? Institutions work the opposite way. They look from the inside out. They ask, what problem does this solve? Can it move value at scale? What happens under stress? Does it still function when liquidity dries up and volatility spikes? That difference explains almost every argument around XRP. Because XRP was never designed to behave like a speculative asset first. It was designed to behave like financial plumbing, the part of the system nobody talks about until it fails. And when you understand that, price becomes a secondary signal, not the primary one. XRP is not equity. It doesn't represent ownership in Ripple. It's not a growth stock. XRP is a liquidity instrument, and liquidity instruments have a design rule most people miss. They must scale in value as volume increases. XRP has a fixed supply. It cannot create more units to handle larger flows. So when volume increases, the system has only one option. Each unit must represent more value. That's not speculation. That's basic system design. This is why institutions don't ask, why isn't XRP mooning? They ask, can this asset absorb global liquidity without breaking? That's the question XRP was built to answer. And while most people are still watching charts, real liquidity infrastructure is already being built. One example is Unic, an on-chain OTC and pre-market trading platform. Unic has already processed over $1.3 billion in OTC volume, serving traders, early investors, and institutions that don't want to move size on public order books. Why does that matter? Because institutions don't position through hype. They position quietly, off-exchange, with minimal slippage. Platforms like Unic exist specifically for that phase of the market, before narratives go mainstream. This is not financial advice. I'm showing you how infrastructure actually forms behind the scenes. Here's something most people misunderstand about regulation. Institutions are not waiting for perfect rules. They're waiting for certainty. In moments of stress, currency instability, trade disruptions, liquidity crunches, decision makers don't look for theoretical solutions. They look for tools that are legally usable, operationally proven, immediately deployable. And XRP already cleared one of the most important hurdles. A court ruled that XRP itself is not a security when traded on public markets. That ruling didn't solve everything, but it removed existential risk. And in finance, certainty beats perfection. That's why assets with legal clarity quietly get positioned before markets panic, not after. Here's a truth retail hates to hear. Institutions don't want price excitement while they're positioning. They want stability, deep liquidity, predictable settlement, quiet absorption of supply. That's why infrastructure assets often look boring right before they matter. Silence is not inactivity. Silence is control. If you saw explosive price action while institutions were positioning, that would actually be a red flag. Price discovery comes after positioning is complete, not before. Retail asks, how high can this go? Institutions ask, what friction disappears if this works? XRP was designed as a bridge asset, and bridges don't care about hype. They care about flow under pressure. In cross-border finance, pressure shows up fast. Currencies move, liquidity dries up, settlement delays become expensive. That's where bridge assets matter most. Institutions are not trying to flip settlement assets for profit. They're trying to move money safely. And that's why higher notional value per unit actually improves efficiency at scale. There's one more layer most people still aren't looking at, and it's probably the most misunderstood part of XRP entirely: supply behavior. Retail investors hear fixed supply and immediately think scarcity like Bitcoin. Institutions hear fixed supply and think constraints under scale. Those are two very different interpretations. XRP doesn't need hype-driven scarcity to matter. It needs functional scarcity, meaning supply that becomes unavailable because it's being used, not because people are hoarding it on exchanges. When XRP is deployed as liquidity, whether through payment corridors, treasury operations, on-chain settlement, or institutional routing, that XRP isn't sitting on an exchange waiting to be traded. It's locked into processes. It's assigned to workflows. It's reserved for throughput. That changes how the market behaves. In early phases, supply looks abundant because usage is light. But as systems scale, the same supply has to support exponentially more volume. And because XRP cannot expand its supply to meet demand, the only variable left is price efficiency per unit. This is the part most people miss. Price doesn't rise because people believe harder. Price rises because systems require fewer units to move more value. That's why infrastructure assets don't behave like memes or growth stocks. They don't explode early. They adjust after utilization forces repricing. So when people say, "There's so much XRP, how could it ever be worth more?" they're asking the wrong question. The right question is, what happens when the same supply is required to move 10x, 50x, or 100x the value it moves today? That's not speculation. That's systems math. Let's talk honestly about risk, because pretending there isn't any is how people lose credibility. Holding XRP is not risk-free. No asset is. But the real risk with XRP isn't volatility. It's misunderstanding what you're holding. If you treat XRP like a trade, you'll be frustrated. If you treat it like a stock, you'll be confused. If you treat it like a meme, you'll get bored. Because XRP wasn't built for any of that. The risk comes when people expect fast gratification from something designed for slow integration. That mismatch creates emotional selling, impatience, and poor timing. Institutions don't worry about XRP going to zero tomorrow. They worry about legal usability, settlement reliability, and liquidity performance under stress. And that tells you something important. The moment XRP stopped being existentially threatened by regulation, the conversation quietly shifted from "will it survive?" to "how might it be used?" That doesn't mean success is guaranteed. It means XRP entered a different category of assets entirely. And assets in that category don't reward impatience, they reward understanding. If XRP succeeds, it won't be because everyone agreed it was valuable. It will be because it became too useful to ignore. And if that happens, the price won't move because of hype. It will move because systems cannot function efficiently without repricing the asset. That's the difference between betting on excitement and positioning around inevitability. This is also where platforms like Unic become increasingly relevant. Unic positions itself as an on-chain OTC liquidity layer, capturing pre-market and institutional flows before they ever hit public exchanges. With features like low FDV access referral incentives, NFT-based perks, early participation mechanics, Unic isn't built for noise, it's built for positioning. Again, not financial advice. Always review the documentation and decide for yourself. Retail is conditioned to expect excitement. Institutions are conditioned to expect reliability. Retail trade stories. Institutions trade processes. That's why XRP feels misunderstood. It's not trying to impress you. It's trying to survive stress. And assets that survive stress don't behave like memes. So here's the honest takeaway. XRP is not a guarantee. It's not a promise. It's not a shortcut. It's a system component. If global finance continues moving toward faster settlement, reduced counterparty risk, regulated digital rails, then assets like XRP don't need hype. They need integration. And integration always comes before repricing.